Hi, everyone. Welcome to the Functional Retirement Podcast, where we merge retirement planning and health. I'm your host, Thatcher Taylor. I'm a certified financial planner. And on this podcast, we're going to explore the convergence of health with retirement planning and how it affects longevity risk, income distribution, protection, estate planning, and everything that goes into an optimal retirement. We're going to do that with some solo shows with myself, with educational videos and topics. But we're also going to utilize expert guests in the fields of retirement planning and health. So without further ado, let's get into it. So thank you everyone for coming to the Functional Retirement Podcast. I'm here with the entrepreneur and equity comp master, Travis Gatzemeier from Kinetix Financial Planning. The reason I really like having you on, Travis, is because you talk about arguably the two things that create the most wealth in our society: being a business owner and getting equity compensation, but also two things that can be catastrophic because businesses don't make it all the time. In fact, more businesses fail than make it, but also equity compensation is so reliant on a company doing a really good job that it seems to bring a lot of risk. So the first thing I want to ask is, how did you get to where you are, to being so deep into business owners and equity comp?
Yeah, Thatcher, thanks for having me on. This is gonna be a blast. But man, I could go on about the journey and how I got here. But a long story short is I always wanted to be a business owner and had no idea what that was ever going to look like. And through trial and error, going up through different routes through financials, and I say I have like a non-traditional route, which I kind of do. But you know, how did I get to business ownership? Was just me having the drive to own a business one day. Finally figured out what that would be. When I first started, I was more in the investment background, derivatives, futures, things like that. So much more of a trading background, and then figured out that that's a very difficult path, especially if you want to run a fund or have a firm. And really got into like personal financial planning and combining the personal finances with the investment advisory part of it. Got Long story short, got into financial planning, then figured out, hey, this is something I can build a business around, like if I have my own clientele and stuff. So ended up launching my own business in 2019. Very, very naively, entered the world into entrepreneurship and had no idea what I was doing, to be honest with you. And I think that's where a lot of people, like, the risky part of entrepreneurship is honestly when you make that first move from employment to entrepreneurship. And we can get into why I believe that's not as risky as what people think. But yeah, I mean, long story short, launched my business in 2019, and through just working with people, working with my type of clients I want to work with, I've narrowed down who I target, who I work best with, which is folks with equity compensation, as you just mentioned, like growing their wealth and building equity through getting paid by company stock, right? That's what equity compensation is. And then entrepreneurs, people that are growing businesses just like me. And surprisingly, there's a lot of overlap between the two, which we can talk about. But that's really, really quick way to tell you how I got into being an entrepreneur myself.
Yeah, that's awesome. And you touched on something that's really interesting, especially in our industry, because we both come from a background that this business that we run now is different than when we started. And when most advisors start, and literally most advisors don't start in the registered investment advisory fee only or financial planning practices that we have now. They start like where you started, where it's very technical: futures, derivatives, maybe some options, individual stocks, trading. There's more of a complexity to it. But when you move over to our side, we start to understand that the planning component around the nuts and bolts of the rules that the IRS and our society gives us is really a bigger value add. And it seems like over that time of that knowledge and then your experience in starting a business led you down the path of being interested in helping entrepreneurs, right?
Exactly. And what you're just kind of going towards was when you're dealing with futures and options and all this kind of day trading stuff, there's a lot of things outside of your control. It's fun, it's exciting, things are moving quick, you can make a lot of money really fast. And I quickly realized that there's so many things that I'm trying to control that are outside my control, and the behavioral aspect of things that it's almost that you have so many things stacked against you in that scenario. But then when you bring in like the planning side of things, right? What you're just talking about, like the actual planning, there's a lot of things you can control with financial planning. There's a lot of things you can control with your long-term investments, like your asset allocation and controlling your behavior and things like that. So when you can stack all those things in your favor, that's where things really begin to compound, in my opinion, for myself.
Yeah. We could do a whole nother podcast just talking about that, like the efficient market hypothesis, or Jack Bogle, just diversified holdings, ETFs, mutual funds that are low cost for a long period of time. We could talk about that just for an hour in itself. So I agree with you. And when I was at Edward Jones, it was just, I remember you go knock doors for a couple of months, you gather a bunch of names, you go to the home office for a week, and in that week, you just call all those names and you sell them a stock, Pepsi, Coca-Cola, and you're selling these individual securities. Then you get them in their foot in the door. That's not how it is now. How you get your business owners in the door is completely different. So tell me a little bit. Let's separate the two. We'll come back to equity comp. Tell me about the business owners, what you've come across and what you've noticed in their planning that sets them up to operate a little bit differently, just say like a regular W-2 individual.
Yeah, great question. And there's so many things, but really, the first thing that really, and we could talk about like how someone comes from like a W-2 job and then transitions into like a self-employed person or entrepreneur, right? And even people that are years into entrepreneurship, they still have these challenges that we could talk about. But really, like the main thing is, one, you have to pay your own taxes, right? So when you're paid from a W-2 employer, you get your pay stub and you see your federal tax taken out through withholding. You see your state tax and your Social Security, Medicare. Like and surprisingly, a lot of people don't even really look at those line items on their paycheck, but it's taken out for you. It's already done. And that's the one thing that really surprises people is if you go to self-employment and now that whatever income or chunk or payment comes into your bank account, well, it's the full amount. There's no taxes taken out of that, right? So it's up to the entrepreneur or business owner to say, hey, how much out of this do I need to set aside for Uncle Sam? And then make sure and even making those estimated payments. So like a W-2 person, the withholding comes out, your company sends that money to the IRS, for example. Whenever you're self-employed, you actually have to go log on to the IRS website, determine how much you need to pay based on how much you earned that quarter, for example, or when estimated payments due, and cut those payments. That's the one thing that really catches a lot of people off guard. And it sounds a little more simple than it actually is, but it actually is pretty difficult to for a lot of people to figure out, hey, here's what came in, here's what I should set aside. And I always tell people, start with 25 to 30%. If you're on the lower earning side of things or just getting started, probably 20% or so to cover all your taxes of the total income coming in is going to cover it. But I tell people, most of my clients, I say, hey, 30%, 35% even, and that's going to cover your taxes plus any potential retirement contributions we're going to set up. So that's one thing, right? That's one thing that catches a lot of people off guard between W-2.
Dude, you're driving a stake right in my heart. Sorry to interrupt, but this exact thing happened to me when I first started in the industry and I first got my own practice. It was years and years and years ago. Got paid X amount of money. I got paid 60 grand in a year and I thought it was the most amount of money. It was years ago when $60,000 a year mattered. I didn't pay any taxes on it. I didn't have any idea. So I had to really cut a fat check. Mm-hmm. Shocked. So if anybody's starting a business or is deep into a business, make sure to pay your taxes. And this even goes into the next step of estimated taxes, which we could talk about. But even if you're familiar with paying your taxes, but you start generating a lot of revenue, paying your estimated taxes, making sure to pay your FICA taxes. There's a lot of things, even your unemployment taxes. There's a lot of different types of taxes that need to be accounted for, but go ahead.
Yeah, exactly. I mean, and this could go on forever about taxes, but you have your federal tax. If you live in a state with state tax, you have both those, but you just mentioned FICA taxes, I think is what you said, but those are, referred to as self-employment taxes when you become self-employed, right? And that's Social Security and Medicare. That's a different set of taxes you have to take. And that's why, going back to what I just said, 20, 25 to even 30%, that's covering your self-employment taxes, which is Social Security and Medicare, plus your federal and potential state taxes. So all that has to be considered. And like I said, that's the main thing that catches a lot of self-employed people off guard when they're making that adjustment, or even couple of years into it. I still have a lot of new clients that come on that have been running a business for years, and they don't have a system to pay estimated taxes or even know how much they should pay in estimated taxes.
Yeah, it's a really unique world. And so this is what transitions. So we're talking about you still got to pay your taxes. It's almost unavoidable. However, people like to start businesses, and I hear this all the time. A person at my CrossFit gym just the other day said this: I run my business, or I have a business to save on taxes. So I want to ask you about ways that you've seen some of your clients save on taxes. But before that, I think we should just tell everyone, when it comes to running a business, there's a lot of different business structures. Sole proprietorships, partnerships, S Corp, C Corps. So you can even be an LLC, but file as an S Corp. So there's a lot of different types of business structures out there. So throwing that to the wind, because again, that's a whole nother podcast. Tell us some ways that you've seen that have been valuable after you figure out, okay, I got to pay my taxes. I know how much to pay. How do I start to reduce those taxes from a business perspective?
Yeah, and it's funny because a lot of people do. They say the same thing. It's like, hey, I'm gonna open up an LLC so I can save taxes, or I'm gonna start a business to save taxes. In my not to like jump too far ahead, but my main message is always like, don't make decisions because of taxes. Like, do the thing that you want to do that's going to move the needle, that you're ambitious about, that you have goals to accomplish, and then figure out how taxes play into that to maximize your dollars. So that's like the first thing, right? You never make decisions because of taxes. And then going back to like the different structures and everything, like a lot of people say, hey, I need to have an LLC to save on taxes. I need to open up an LLC, for example. That's not the case. If you're a sole proprietor and you just start earning money that's outside of an employer, right? You just start earning money on wherever it could be. You get paid from something, you're a business owner, right? Something that you're creating, getting paid for. You can be a sole proprietor and still create deductions, right, that are necessary for the business. Like, it's the same for an LLC as it is a sole proprietorship. So there's no tax advantage to being an LLC, for example. You get the same deductions. So that's one thing that I hear a lot of people talk about, and what you kind of said about how do I save taxes. But so you want to talk more about like how do people reduce their taxes as well, like once they become a business owner?
Yeah. So I'm going to show everyone something that I think will kind of get us going in the right direction, because I really like what you're saying. So I'm going to pull something up. If you're on YouTube, you'll be able to see this. If you're listening, I'm sorry, you can go to YouTube and check it out, but I'll link this below so everyone can take a look at it. So here's what I'm going to do. I'm going to show something I think will add a little bit of value for everyone. If I can pull it up. So this is the Schedule C. Can you see that?
Got it.
So this is the Schedule C. This is very interesting. So this is what I like to show a lot of business owners when they start to talk about ways to save on taxes. The IRS has already thought this through. So they create a lot of these categories right here in part 2, expenses. Now, this is going too deep into the weeds, but depending on your business structure, these are the types of places where you can talk about write-offs. Everyone thinks about, you buy a new vehicle, or you got a bunch of advertisings, or you go out for meals, that there are all these write-offs. So write-offs are the first thing kind of pop into people's mind when they talk about running a business, which is true. So have you seen a lot of your clients start to utilize these write-offs properly to help make a more of efficient tax situation? Talk a little bit more about that and how it kind of passes through to their personal tax return.
Yeah. I love that you're bringing write-offs into this, because that is the lingo, right, that everyone talks about when they want to open a business or do something, right? Like, I'm get these write-offs, or hey, I'm going to do this because it's a write-off. And this is great. You have the sheet, you have the IRS document up here, which is where all the expenses are captured. But everything that you see in here, a write-off is just an expense, right? So it's an expense that applies to the business. And where a common misconception, I think, for a lot of especially new business owners is, hey, I'm going to write this off like it's free money or something. And a write-off is not free money. I like to tell people it's think about a write-off is spending pre-tax dollars instead of after-tax dollars. So when you're an employee, you get your paycheck, taxes are taken out, and then you go buy something, right? So like if we use an example of an expense on here, if you're an employee and you're paying your cell phone bill, for example, right? And this also goes along with your tax saving example too. Your cell phone bill is paid with after tax dollars, right? But if you become a business owner and you use your cell phone all the time, for example, that cell phone now becomes a business expense. So now you're able to pay for the cell phone bill if it is necessary in the business. You're able to pay for the cell phone bill before you're taxed, right? Because it's an expense, and expenses reduce the amount you're taxed on. So that's essentially what a write-off is. And another way to think about it is all these things that apply on here, or the majority of them rather, you're saving, from a rough standpoint, like if you're spending $1 on advertising, for example, you're probably saving about 30 cents in taxes, depending on where you lie in a bracket, your income and everything. But you're not getting free money. Like if you spend $100 on advertising, you're not saving $100, right? It's not free money. You're saving a portion of that based on where you fall from a taxable income perspective. So that's kind of what write-offs are. And it is confusing, but it is a benefit to a business owner, right? The more things that you deduct in the business, the lower your taxable income is going to be, but it needs to be something necessary in the business. I've seen tons of tax professionals, financial advisors. One of my largest clients came to me, and his tax professional, when he first came to me, his tax professional was having him buy a truck to reduce his taxes. He didn't need a truck. And things like that happen all the time, where someone will say, hey, if you purchase this big asset or this large expense, it's going to reduce your taxes. And yes, it will reduce your taxes, but you're also going to be spending money to do that, which lowers the profitability of the business. And it may not be the right long-term plan for the business either. So those are things to consider whenever you're thinking about write-offs and deductions and stuff like that. It has to make sense for the business. And if it does make sense and it propels the business forward, then it's a good thing that you can get the deduction because you're able to spend pre-tax dollars on that.
That's right. Yeah, that's a great way to explain it. Especially, it's not a dollar for dollar tax savings. Like you buy a $50,000 vehicle, it doesn't save you $50,000 in taxes. And this kind of document proves that, where you take here on line 7 your gross income, how much money your revenue the business produced, and then you deduct out all these expenses. And it gets you a number where it's a net profit or loss. This is the number that kind of passes through to other areas, like your 1040, for example, where you do potentially have a tax burden still. It just helps reduce down the income, but you still got to pay taxes on a large portion of that it still costs money. The truck still costs $50,000. So I think that's a really good point.
Yeah, 100%. Yeah. The bottom line is you're taxed on the net profit of the business, or essentially the net profit of the business, after all your deductions and everything. So yeah, good point. A lot of people don't realize, what number they're actually taxed on.
Yeah, absolutely. So what about some other things that people can utilize? So we just talked about expenses, but we haven't talked about potentially contributing to retirement. So the unique thing, and the reason I kind of separated business from equity compensation, like for a big employer, like a publicly traded company, the reason I separated them is because I think business owners have a unique transition to quote unquote retirement, where a lot of times it's undefined, or they set up the business where they can maybe do some passive work in the business and still receive some revenue. So maybe they're working a little bit longer in whatever quote unquote work looks like. But utilizing some different retirement accounts while you're a business owner can be really valuable. Do you utilize those a lot for your clients?
100%. And again, just, if you're at an employer, you get, when you sign all the documents and you sign on with a new employer, you get 401k set up along with everything else, right? When you're a business owner, now along with the tax situation that you got going on, you have to figure out, hey, do I have cash flow and profits to be able to contribute to a retirement plan? And to answer your question, yes, that is something we walk through with clients is, hey, is it necessary? Are you at the point where you can do this? And what type of retirement plan can you set up? So there's multiple different types. I work with a lot of solo business owners or 1 or 2 employees. So very, very micro, small businesses. So common retirement plans that I usually set up are going to be, and I'll start with like the basics of them is not necessarily a retirement plan for the business, but an individual retirement account, or Roth, which Roth IRA or an IRA that a lot of people probably heard of. That's like the first ones that we're going to look at, right? Because if we're not at the point to put more than the $6,500 per year, for example, in one of those accounts, we're not going to go open up a business retirement account just to do that, right? We're going to go with the easy, low hanging fruit of just getting those contributions in place. So for anyone that's starting a business and you're starting to get profitable and you just want to start putting a little bit aside into retirement accounts, don't think you have to jump to the more complex things or the cool things that everyone's talking about. Start with the simple ones: IRA, Roth IRA, right? Very, very easy. And then once you start gaining profitability or even hiring employees, a common one is called a SEP IRA. So your limits start going up. They're higher than they would be with an IRA or Roth IRA, but the amount you can put into those is going to be based on the business profit. So that's why if your business isn't super profitable yet, it still may be wise to look at like a Roth IRA or IRA. But the one I really like using with clients is what's called a solo 401k. And that's really for solo business owners, right? So no employees. With a SEP, you can have employees, which makes that one a little more attractive. But I use solo 401ks, which gives us a lot higher income limits. It's based on the profits of the business for the employer side of things, because remember, when you're a small business owner, you're essentially the employee and the employer. So solo 401k gets to mix both those things together. But on the employer side, it's essentially just like a SEP IRA. But like everyone's familiar with, like your work plan 401k, you still get the annual contribution limit of an employee, which I believe is 22.5 for this year. So you can combine both those things in a solo 401k to really compound contributions. So those are like the three main ones that I walk through and work with the clients, and where everyone should kind of start if they're at least in their first couple of years or a solo micro business owner.
Yeah, those are awesome. Those are all kind of the same exact. That's the direction that I wanted you to go with that. And a lot of this is not just for young people just starting their business. This could be, say you're 55 and you want to transition out of your career and you want to start your own business. You want to have some sort of functional or flexible retirement. This is what you're going to be falling into, because you mentioned it twice. When you work for a company, it's all set up for you. You just got to sign the documents. You usually get your login to your Fidelity 401k or your HSA. But now, in a business owner, you're in charge. And I just want to kind of dive in deeper to those different account types that you discussed. So the IRAs, which they have contribution limits, and those are all from the personal side. So an IRA and a Roth IRA are all personally owned. The SEP IRA is the next level up where you can put more into it, but now they're just employer contributions. So you can put more into it, but you're kind of stuck based on that revenue calculation, the net income calculation you talked about before. But then the solo 401k is really cool, like you mentioned, where you can add even more to that, because now you get the employer contribution and the employee contribution, which allows you to contribute way more to that account. So those are three. I feel like those are kind of the biggest methods right now. And then you could go in outside of the solo 401k, the creation of an actual 401k. If you have multiple employees, you can use a SEP or a simple for multiple employees as well.
Yeah, exactly. And then there's little nuances and things to watch out. For IRAs and Roth IRAs, right? There's income limitations for Roth. So, if you're wanting to do contributions and you're above the income limits, like backdoor contributions, and then SEP contributions, as of right now, I know this has changed in Secure Act 2.0. They're supposed to be adding the ability for Roth SEPs. I have not seen one yet. So if you've seen one, let me know. But previously, you weren't able to have SEP Roth contributions. So you'd have to do like SEP plus Roth or something like that. And then solo 401k, for example, as outside of just the higher contribution limits, you do have the ability to make Roth contributions in those as well, if the custodian or where you open the account allows for those. So some don't, some do. It's just a matter of finding one that does, if that's something that you want to set up.
Yeah, that's awesome. And you're exactly right. Secure Act brought the Roth back with a vengeance, even allowing employer 401ks, actual 401ks if you work for a company, which we'll get to in a little bit. Sometimes making Roth contributions mandatory for matches, depending on income limits and stuff like that. So the Roth's back with a vengeance. But before we switch to equity comp, do you utilize any sort of process or thought process for your clients? And here's what I mean. Are clients generating however much they're generating gross revenue, 100 grand, 500 grand, $1 million, and they filter their way all the way down to getting their living expenses? Is there some sort of process that you help clients work through that starts with their revenues, their taxes, their expenses for the business, and then making sure they're contributing enough for whatever retirement they're envisioning. Do you have any sort of process that you can kind of discuss or walk us through?
Yeah, and it's going to vary for everyone. So the first thing is just, and it really depends on what stage of the business you're in too. Like, are you just beginning? Or are you 10 years into the business, 5 years, whatever. But I mean, just simplicity talk, simple. I don't know what I was trying to say was simple. Simplistically speaking, we want to look at like how much revenue the business is bringing in, and then how much net income it's bringing in. But where a lot of business owners get kind of where they struggle with when they come over to find me or are interested in my services, this is where they really have the hang up, is how do I take what's going on in the business? Like, I'm so focused on the business and doing that thing and building it and getting all the profitability and whatever comes, whatever the business is doing. How do I bring that into the personal side? Right. So what we want to figure out is like, how much does it cost you to live? What does the business need to supply you? And then looking at things like, hey, are you the right entity choice? Do we need to, if you're an LLC, do we need to make an S Corp election? Do we need to set you up on some kind of salary? So it's just drilling down on first, how much is necessary from the business to bring into the personal side? Like, how much do we need? And then figuring out how to set that up on some kind of cash management system where it's a potential a little more stable than it was. Like, a lot of business owners will, revenue comes in from all these different sources, right? Could be up and down, up and down, up and down. And then they bring it into the personal side in the same fashion, so variable in, variable to the personal side. So we want to figure out like, how do we get the variable income into stable income and use that stable income to cover most of the living expenses, right? And then any additional profits, like maybe that gets reinvested into the business, if that's a goal. Maybe those profits get passed down to the personal side to cover personal goals or retirement accounts, things like that, right? And also the tax strategy and holding taxes aside and stuff is part of that cash management strategy. So really, it's just how do we funnel the business into the personal side, and then where does that need to go? So like I mentioned, does it need to go to retirement accounts? Does it need to go to short-term goals? And that's kind of outside of all the tax strategies and things we may look at as well. But really, it's just trying to position the business in a way that it can come into the personal side and then accomplish the business owner's goals. Does that kind of answer your question there?
It does. Yeah. And I mean, using myself as an example, the majority of my revenue comes in quarterly. So business owners have to be very cognizant of how their revenue comes to them. It could be a little bit more volatile on a month-to-month basis or a quarterly basis or an annual basis. So having a good handle, or as much as you can, on the business expenses and the personal expenses, like you mentioned, how much you need as a person, as a family to survive, and making sure that revenue, because what people don't understand is if you generate $500,000 of revenue, in theory, that $500,000 is taxable in some capacity. Until you start working through expenses and the deductions and write-offs and filtering money to your personal situation. So that's where it starts to get very detailed and intricate. And like you said, it's different for everybody based on where they're at in the business and kind of their structure. So yeah, I think that's very helpful.
Yeah. And I will say, like, my number one rule for business owners is never run out of cash, right? And that just goes back to the cash management, is you always want to have the business functioning in a way that's never going to run out of cash. Because if you're ever, it's just like investing, right? We never want to put ourselves in a position to be forced to sell stuff, right? Because of bad cash flow management or bad investing, right? So whether that's helpful or not, like, that's my kind of, when we're looking at what does the business need, we also, as we're talking about the personal side, how do we bring the business into the personal side? We also want to look at the business and say, hey, what does the business need to have as its lifeline and support and cash reserves and things like that, right? That way it never runs out of money, because if the business runs out of money, well, now guess what? Now there's nothing for the personal side, right? So it all, as much as it's like a separate deal, it's all combined together whenever you're planning with a business owner.
That's right. Yeah. Yeah. That's a really good point. The business it's really cool. The business, like I mentioned, if you want to be wealthy, it seems like one of the ways to do it is to be a business owner. But the ones that usually do it, it seems like they have a good handle on what they're doing with their money. And that's the value in planning, right?
Exactly. Yep. It's because you have direct control. The decisions you make and the things that you do within the business, you control those things. And the better decisions you make, the better the business is going to perform, right? All the tax things are cool. It's cool to save money on taxes, but as a business owner, like if you want to get to the position where it's building wealth or building financial freedom or flexibility or whatever, or selling the business one day, you want to focus on profitability and growing the business and putting all your efforts into the business. Like the tax strategy, I think I mentioned this at the very beginning, but the tax strategy shouldn't be like the thing that you focus on all the time. Like so many business owners like, hey, I have this huge profit. How do I save on taxes? It's like, wait a minute. So you got into the business to be profitable. Now you're profitable. And now you're telling me you want to be less profitable and pay less taxes is essentially what it is. So never lose sight of the fact that you want to grow the business. And that's the thing that's building the wealth. That's attached to the vision that you want to get towards. And then as time goes on, if there's strategies that maximize your dollars or maximize your after-tax dollars through the business, like use those things, right? They're there to be used. Like that's what tax strategies are for, but don't focus on them primarily.
That's right. Yeah, exactly. And this is why one of the reasons I believe that the business is very similar. It's a great wealth building tool, but comparatively to the equity comp when you work for a company, this is why I believe the retirement vision is a little bit different, where I feel like a person working for a company in most cases, not everybody, in most cases, it seems like they kind of have an end in mind. Like there's some sort of date. There's not a big sale or event that happens like a business owner. The equity events that happen in a W-2 job with equity compensation, they happen over a long period of time. And then you finally kind of get to the point where, all right, I'm good. I want to retire. And you're just gone. You maybe will take some options with you. So just to set the stage for the equity portion, there's a few options. There's like stock options, qualified stock options, incentive stock options. Non-qualified stock options, incentive stock options. There's restricted stock units. There's a variety of things that come into play. So what kind of started you on the path, and was it just experience that led you down to, I think equity comp is something that really needs to be brought into my business and really paid attention to?
Yeah, when I was narrowing down my focus areas, just like the entrepreneur thing that I work with, I just kind of looked at who my clients were, and this is when I was trying to have more of a focus in my practice, right? I kind of looked at, hey, what do my clients look like? So some are entrepreneurs and get self-employment income, whatever. But the other good 90% of the other half of them were equity. And I was like, man, I really like planning with equity because there's so many opportunities. Just like as an entrepreneur, there's so many things that you can help them out with. We just mentioned all the different things that they don't get from an employer, how to structure their business and things like that, right? On the equity side, there's all kinds of tax plan things to happen and helping people understand what their equity means. And most of all, how to use it, right? Because just like a small business owner, like both of them have equity. Like it's equity that can be used for some future thing, whether, could be anything, wealth, financial freedom, whatever. That's the intention of both of them, right? And they're usually big chunks of money, right? Your business is worth a lot. You get a lot of equity from your company, which means if you're paid in stock, for a lot of people that don't have a plan, probably have a big chunk of their assets in company stock. The only difference is an employee really doesn't have control over that stock, right? They may work in the company and have some insight, but really a lot of their decision-making is not going to move that stock, right? And we can talk about all the different types of ways that equity compensation is paid. But the last thing I'll say about the combination of the two is like, surprisingly, there's lots of overlap in the planning, right? Because we just mentioned one, like variable income from the business. Stock compensation is variable because when you get paid, the stock is going to move from last time you got paid, right? So it's going to be constantly going up and down depending on the type of compensation you have. The tax planning, right? People with equity compensation still may have to pay estimated taxes. And we can talk about scenarios where that happens too. And then they're both owners, right? They both have a large ownership in this potential this asset, right? So lots of planning scenarios between the two. But that's kind of how I dove in and how I got into adding equity comp as a part of my planning specialty. Is, hey, a lot of my clients have that, and I just went all in, kind of learning alongside of them and helping them plan with it.
Yeah, absolutely. And I think you touched on the biggest thing about equity compensation is it's cool to get the big payouts, but the tax ramifications. A lot of times when people first get involved with equity comp is when things happen, options are exercised or RSUs are paid out, there is usually some sort of surprise. But also where the surprises come is after you exercise or maybe you receive the RSUs, you own some stock and then you sell it later. Then you create an even potentially bigger or different type of taxable event. So yeah, let's dive into some of the tax planning opportunities with equity comp. You can utilize whatever type of equity compensation you want to, but let's try to dive in a little bit to how do we prepare for taxes when it comes to equity compensation.
Sure, and yeah, there, as you mentioned, there's many different kinds. And incentive stock options, probably the most confusing one. A lot of my clients no longer have that incentive stock options, so I don't see that as much now, but it's still out there, right? And that one, we won't dive into that because I could go on forever about how you exercise those and tax implications and things like that. But the biggest thing with incentive stock options is to watch out for AMT. So potentially a huge tax bill comes your way and catches people completely off guard whenever you exercise incentive stock options and think you're kind of, hey, nothing happened, and you may get hit with this huge tax bill. So I don't want to dive too much into that because that gets really confusing quickly. And then you have non-qualified stock options, which are a little more simple. I do have some clients with those as well. They present a really awesome planning opportunity. But the most, and where I think most people would relate to and what they have is restricted stock units or some kind of stock unit, right? Those are the easiest to understand. However, they do have some little tax consequences that catch people off guard as well. So I would say, like, I think every one of my clients that has some kind of equity has RSUs, right? It's the most common, especially when your company is public.
Yep. And then potentially even like an ESPP, because some of the options in
ESPP too,
RSUs
yeah.
are for some of the higher income earners within the company or like mid-level employees, but employee stock purchase plans too. And each one is so different and complex. RSUs do seem like the most popular one. And just a little background for everyone. So RSUs, you basically get a bonus at some point. You meet the time working at your company, the stock price goes up, and at a certain period of time, you get some RSUs. And instead of you getting a $100,000 bonus, you might get X amount of shares at whatever the stock price is. And that is automatically W-2 compensation. But now you own the shares of stock. So you get taxed right when you get them, and now you own the shares of stock. And then you got more tax decisions along the way. That's probably what you run into the most, right?
Yeah, exactly. So, just breaking down the taxes to clients that have it, and a lot of them don't realize how it works. And we can kind of go into a little more detail about it because, when you're granted RSUs, nothing happens, right? You get this grant document that says, hey, you get this many RSUs, right? And this is how much is going to vest over whatever period. And then on the vesting dates that's set forth in the grant, those shares are now yours, right? So the value of that, you won't know until it vests because you got to wait to see what the stock price is. And that's what I was talking about, variable income, right? You could have based on stock price fluctuating every year, the income coming from RSUs is going to be variable, right? But you kind of nailed it, is as soon as the RSUs hit the paycheck, right? So as soon as they vest, they basically hit your paycheck, right? And they are taxable income at that time. They are earned income right when that happens. There's nothing else you can do. And a lot of people, they get confused when I tell them this, but there is no tax advantage to holding RSUs after they vest, right? It's no different than your company giving you a bonus and you going and buying shares. It's the same thing. They're just having you skip a step. They're buying the shares for you or giving you the shares that you own. So RSUs are taxed as ordinary income. They are subject to Social Security and Medicare tax as well, unless you're over the wage base for Social Security. So that's something to be aware of. And what usually happens, and this is how most of my clients are elected. Sometimes this can be changed depending on the company, but what usually happens is when RSUs vest, let's just say you got 100 RSUs, 100 shares, for example, and the taxes were 5 shares worth. The company is going to sell shares to match the tax liability, right? So they're going to estimate your withholdings and your Social Security, Medicare, and they're going to sell the shares to cover that tax liability and deposit the rest in your account, right? And the statutory rate for tax withholding on the federal level is 22%, unless your income's over $1 million. So I find a lot of people where they get caught up is they may have gotten a ton of RSUs, or they may be a really high income earner, right? Under $1 million, but still a high income earner. and the company only sold enough to withhold 22%, right? But their total tax bill may be well above that for the year. So what I usually do frequently with people with RSUs, for example, is run tax projections once or twice per year when they vest, and say, hey, here's our estimated tax liability. It looks like we still need to cover some of the tax liability. So we either sell more RSUs to do that, or make sure we set aside enough cash to cover that tax bill and potentially pay an estimated tax payment if we need to. And for a lot of people, just knowing that is powerful, right? Because the worst thing you want to do is get to tax time, file your taxes, and your CPA says, hey, you owe $23,000 from the RSUs. And you're like, what? And if you knew that 6, 7, 8 months in advance, plan for it, at least understood it at minimum, much easier for you to kind of cope with at that time. So that's the one thing that really gets, that I find is super valuable for people, just understanding how much is taxed, how it's taxed, how much is withheld, and then make sure we plan for that.
The dreaded surprise. I've been fortunate, I haven't ran into this, but I've heard of people where because of RSUs, they will get literally tens of thousands of dollars in a tax bill when they file their taxes for the prior year because they weren't withholding enough. It's a pretty substantial thing. And even little things where the W-4, what everyone uses to elect their tax withholding each year, or when they start their employer, the W-4 is changed. So even then they might not be withholding taxes just from their regular paychecks. And then if you couple it with some RSUs where the statutory withholding is in place, they might not even be close. So that's, again, part of the planning component, just taking a little bit extra time or getting a professional to help clean that up for you.
Yeah, and I'll tell you a really not unique, but a scenario that this happens the most is when someone works at a private company. What can happen is if they get RSUs, a private company sometimes will have what's called a double trigger RSU. So like normally an RSU has a time-based vesting, right, where it vests over a certain amount of time. And when that time is, when you've completed that time, you get the shares, right? They've vested. A double trigger RSU is usually at private companies to where they say, hey, you have a time-based vesting, right? And then the other trigger is going to be like a liquidity event, like an IPO. So I've had employees that have been at a private company and they've had 3 or 4 years of RSUs that have met the time-based vesting, right? But they still don't have them. They're just kind of piling up because they still have to meet that second trigger. And then once the company goes public, now the second trigger has been met. But there's 3, 4 years of RSUs that have been piled up. And all of those are going to invest on the second trigger. And that could be $300,000, $400,000, $500,000, $600,000, $1 million worth. And that's all taxed on one paycheck. And that's something to really be aware of, because I've seen many times where someone wasn't even aware that was going to happen. And they are super glad that we held aside taxes for that and created the projection to say, hey, you have $80,000 we need to cover from this RSU bill. So that's a pretty unique scenario. I wouldn't say it's unique, but it's an interesting scenario that a lot of people don't even realize. Private company
absolutely.
RSUs.
It's just the power of taking an extra minute just to think through it, because it's not like you paying the taxes properly early means you're going to save money in taxes. You got to pay what you're due, but the feeling of you having to cut a check later on down the road that's unexpected is such a difficult feeling. You never know what's happening in life. Sometimes it could be hard to come up with 5, 10, 20, 30 grand in taxes that were due, that maybe addressing them right at the time would have just taken care of that for you.
Yeah, and it's much easier if you have to sell shares. It's much easier to do it around where it vested at, because you're taxed at whatever it vests at, right? And to try to sell it around that, then you don't have to deal as much with capital gains or sell it for less than you were taxed on, right? So selling it right around there if you have to sell to cover your remaining tax bill, because if you didn't know that you had a tax bill to cover and April comes along and now all of a sudden you're forced to sell because you have a big tax bill to cover. What if the stocks drop 20 or 30%? Now you're forced to sell at a much lower price and kind of interrupt that compounding, right? So it's much easier to do it way ahead of time. From a behavioral standpoint, that's the most important thing.
Huge, phenomenal point. Great point. the idea that you might have to dip back into the stock that you already own and it could be worth less, because we know an individual company stock could be volatile in the short term for sure. That's a phenomenal point. And that's kind of the same thing that comes into with non-qualified stock options, with which function a little bit differently. To be honest, I haven't seen many ISOs, incentive stock options, and they are taxed differently, especially with AMT. But non-qualified stock options are a little bit different with how they're taxed after you basically exercise the stock options, different than RSUs, where you're really only taxed on kind of the difference from the grant price. Is that right?
Yeah, you can control the time. So RSUs, I like to say this about RSUs. You can't control the timing of the taxes. When they vest, boom, taxed. With stock options, like non-qualified stock options, for example, you can control when you're taxed because you can pick when you want to exercise it, right? So you're granted this stock option, which means you can purchase this stock at a super low price, whatever it's granted at. But a lot of times it doesn't make sense to exercise that. Depends on where the stock price is and you know how low the grant price is compared to the stock price and everything. But you can control because you can pick when you exercise that, right? So you can kind of push off the taxes or exercise those potentially whenever you're in lower income years, for example. You can pick and choose when those times are going to be. So it becomes a little bit easier to manage. I wouldn't say easier, flexible. It's a little more flexible for you to manage taxes with non-qualified stock options. And I have some clients with non-qualified stock options, and for those, we kind of earmark those towards goals. Like a lot of times with RSUs, we have a good plan in place before the vesting period happens, and we know exactly where those are going to go, right? We know how much we're going to sell. We know where it's going to go. Same with NSOs. Like we don't exercise those. We have for most part, we have a plan for when we may exercise them to go towards kids' education or a future purchase of land or something, right? So those are kind of like on top of the other assets that we have for a lot of times with NSOs.
Yeah, absolutely. I like the word flexible. You just have a little bit more flexibility. And I know today with either situation, whether it's a business owner, an entrepreneur, or some sort of equity compensation that we've been talking about, we've talked a lot about taxes, which could be scaring to people. We want to be clear. These are good things. These are good things that you just have to really plan for and be strategic with, and then they don't become issues. If you just leave them to their own devices, then it becomes a problem. But if you're getting big chunks of equity comp, that's a good thing. Those are bonuses. If you're getting a really successful business with a lot of revenue, that's a really good thing. Most people don't get that. So although we're talking a lot about tax and kind of potential bad situation, we're just preparing people for what could potentially happen and not turn a really, really good situation into a really upsetting situation.
Yeah, because the worst thing is to be surprised, have a tax surprise. I mean, that is just the worst thing. And if you can be proactive and plan ahead and maximize your after-tax dollars over the long term, like that's the goal, right? We all have to pay taxes, one of the biggest expenses most people have. So you have to pay them. But in the end, it's all about like making decisions that's going to benefit yourself, whether it's financially or health-wise or just experiences or just whatever your vision is. Like that's why we use money. Put your dollars towards those things, like the most important things you want to accomplish, right? And then bring in the tax component. Like where can you optimize taxes to increase your lifetime or decrease your lifetime tax bill and kind of increase your after-tax wealth or flexibility?
That's exactly right. Yeah. And we haven't even really touched on that. Kind of the biggest piece of this is really developing that future vision and taking and implementing really practical steps to ensure that that vision that you have in the future is achieved as much as we can get there. And that vision could be anything. Everyone's vision is a little bit different, but a lot of times in retirement, a lot of this comes down to the reason why we're talking about these two things is what are we using to generate enough income to live the life we want, that flexibility, that freedom that we're looking for. With an equity comp, if you're a W-2 employee your whole career, a lot of what you're going to do is probably going to be Social Security and distributions from existing investment assets. If you're a business owner, it's going to be something similar if you've been utilizing retirement accounts, but maybe you're receiving some sort of distribution from the business along the way and maybe some Social Security income. So a lot of these decisions when we talk about taxes, it's just setting up the stage for what you want your future retirement to look like. How deep do you go into that with some of your clients, regardless of kind of where they're at as far as a business owner or a W-2 employee?
Yeah. And you're referring to like setting them up for how do we utilize all this to set them up for a potential retirement or whatever they vision in the future, right?
That's right. Yeah.
Yeah, I mean, it's just going back to like what is all this supposed to get you towards, right? Money is just a tool that we can use to accomplish things, right? So a lot of people say money doesn't, create happiness or whatever, but it can create a lot of freedom and flexibility, right? It may not be happier from like a day-to-day living, but it can open up a lot of opportunities. So how do we, whether you're a business owner or have equity comp, like it's important to have a plan in place to utilize these things and these tools to work towards what you envision your future life to be like, or flexibility in the midterm. Like for a lot of my clients, we make sure that we set up like our short-term planning, right? Which is like cash reserves and goals and short things we want to do in the next couple of years, and then create a ton of flexibility in the midterm. But also we're always focusing on like, hey, if things change, or maybe you don't want to retire now, but you may want to in the future, like we want to make sure we lock in a future baseline. I call it securing a future baseline, right? Through retirement accounts and long-term investment accounts, right? If we can secure that future baseline, that allows us to keep those dollars compounding for the future. And then whether you're equity comp or get paid a lot of equity or a small business owner, you can hold more stock or invest more in your business, and those things can be transformational above the future, the baseline that you've built, right? So the baseline always gives you something to fall back on. But building the business, building equity in things, growing things, that allows you to have more optionality and potentially transformational wealth above everything else, which in my eyes creates a lot of independence and flexibility.
Yeah, absolutely. I view it kind of in two terms, where the short term, the taxes, the year to year, the exercise of options or the RSUs or the business expenses, that's very tactical. It's very short term. It's very active right now. But then there's the overall strategy. Why are we doing a lot of this stuff? What's the overall strategy that these tactics are applying? And I think that's a really good way to distinguish the difference, where we're doing things each year and a year passes so quickly, but why are we doing these certain things and making these certain decisions? Like, what's the whole point and the purpose behind it to create that freedom? What have you noticed as we shut this down here? I kind of like to ask one question. What do you notice are the biggest mistakes? We talked about a lot of them. And give me one big mistake and one of the smartest things that you've seen clients do along the way, or that you've helped them do along the way.
Biggest mistake. I have a lot of little bitty ones. Biggest mistake, I wouldn't really call it a mistake, but I kind of alluded to this in the beginning, is people like talking about small business and entrepreneurs, right? A lot of people think that entrepreneurship is really risky. And we talked about how risky it was when you first start, right? And the reason I don't call this a mistake is because it's more of a fear. Is a lot of people want or intend to launch a business or do something or follow their dreams, ambitions, whatever, and they never take the action, right? So it's just not a mistake, but it's like failing to take action and actually moving towards the thing that they ultimately want to get towards. And the reason I said earlier entrepreneurship is not as risky as most people think, it's like once you get over the initial hump of entrepreneurship of, oh, I do everything on my own now, where do I even start? Taking action is the hardest part. But then, it's like if you're an employer, you have one person that can get rid of you, right? One person that can remove you from your job, right, in an instant. When you're a business owner or entrepreneur, if you have worked with clientele, for example, you have 40, 50, 60, 80, 100 people that now are your bosses, right? So it's, from that aspect, it's not really risky. So it's like, I find people just lack taking action and getting over the hump when they want to do certain things, right? Again, it's not a mistake. It's just having clarity and just getting over the fear of doing it.
Yeah, I like that.
And then what was your, so it's a little bit different than probably the answer you're looking for, but
Yeah. What do you think?
Like the
No, that's
non-traditional.
great. That's phenomenal. And then what do you think? The next question is, what do you think is some of the best things that some of your clients have done to really push the needle and really help promote their growth?
This is a terrible answer, but it's really cool when people follow your advice. And I mean, it's a terrible answer, but it's like it is. I mean, that moves the needle. Like when we come up with a plan that's proactive and we collaborate on something, and it's exact blueprint that's kind of built to get them to where they want to go or projected to get them to where they go, and they're sitting there like knocking off the list and taking action, and they're like, "Oh my gosh, I would have never been able to do this stuff." Like that's really cool. Um, so again, not necessarily a direct answer to your question, but just what popped into my head first.
No, I think that's a great answer. And whether it's with us as like financial planners, maybe it's a business coach or something within the business. They followed the plan, they implemented the steps, and it really paid off for them. Because I do think a lot of people destroy growth by they don't implement what they're supposed to be doing. And then I don't know, however much time down the road, they look back, man, I should have done that. So they avoid
Yep.
it. But some of these actionable steps really do add a lot of value. So I think that's a great answer.
Yeah, and as an advisor, I tell people this all the time. It's fun to do the tax strategies and put together a plan and say, hey, here's what you need to do, walk through the trade-offs and things like that. But the real value that I find being an advisor is helping people stay accountable. Like, here's what you wanted to do, here's why we're doing it, and here's what we need to do, and helping them actually get it done. Because a lot of people don't get things done. If you just give them a piece of paper with all the things they need to do, they're not going to do it. But if you walk them through it and always check in on them, keep them accountable to why we're doing it, that's super cool. So I think, like, as an advisor, that's one of the biggest benefits that I believe. The biggest benefits of having an advisor or a coach or something is keeping you accountable and doing the thing that you're supposed to do to get you to where you want to go.
Yep. Yep. I love it. Travis, you crushed it today. Tell everyone where they can find you.
Awesome. So website is Kinetix FP, Kinetix FP for financialplanning.com. That's where my website is. I'm pretty active on Twitter. You're not going to be able to spell my last name, but it's T_Gatzemeier. Probably find the spelling in the show notes or something. But very active on Twitter. That's where I tell people, if you want to interact with me, find me on Twitter. I post on there pretty much every day, so random content, things like that. And from Twitter, you can find my on my profile, you can find the link to the rest of the stuff, like my newsletter and website and everything like that.
That's awesome. I'm going to link them both in the show notes so everyone can find them very easily. If you're on YouTube, it'll be in the description below. But Travis, you killed it, man. I guarantee you added a lot of value for the listeners today. And if anybody wants to learn more, they can go check out those links and find Travis. Thank you, man.
Awesome. Enjoyed it.